Good day, ladies and gents. How are we all doing? I hope we're all good. So, welcome back to this book, which we're going through Market Structure and Powerful Setups, Forex Market Price Action by WadeFX. So, we are currently on chapter 3. So, we are just going to quickly go to chapter 3 without wasting much time. Right, let's quickly scroll up. All right, so today's topic is liquidity. So that's chapter 3. All right, so if you've got any other understanding of liquidity besides what the author explains, please do share with us in the comment section. All right, so liquidity. The Forex market is a zero-sum game, which means that for a trader or institution to buy or sell one currency pair, it's necessary that there is another trader or institution with an opposite position. If smart money or the banks want to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called liquidity. So at any point when the author mentions smart money, that's your banks, like your major banks, which trade. All right. So the liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. Smart money need to activate the stop losses of existing orders in the market so that they can place their positions in the market. The banks manipulate the price because of liquidity, but why? Banks negotiate large trading volumes and sometimes find it difficult to find the other side of their trades. So they have to manipulate the price so that they can have their positions in the market. Excuse me. So there is two types of liquidity. In the Forex market, there are two types of liquidity, which are the buy stops liquidity, abbreviated by BSL, or the sell stops liquidity, abbreviated by SSL. So on my side, you might hear me refer to this buy stops liquidity as a buy side liquidity. Then you might hear me refer to the sell stops liquidity as a sell side liquidity. The abbreviation is still the same. So please do not mind my terminologies. Are mainly used to referring to this as buy side liquidity, which is the same thing as the buy stops liquidity. And the sell stops liquidity, I refer to it as the sell side liquidity. All right. So buy stops liquidity, or BSL. The BSL is originated by stop loss of sell orders. After the BSL is taken, the market reverses to the downside because the banks use the BSL to place sell orders in the market. All right. Let me see if there's a visual. Okay, there it is. Okay, so what do we focus on if we are looking for buy side liquidity or for buy stop liquidity? Our main focus is usually, or rather, our main focus has to be on the previous month's high, previous week's high, previous day's high, the high of the current day, the old high, or any swing high which you see. So a swing high is simply this, right? These are your swing highs. Wherever your price is like turning, that's your swing high. All right. Or equal highs, which is mainly the retail resistance. So I believe we are all familiar with this, but there is illustrations which is going to make it easier. All right. So if we want to look for the buy side liquidity, it means we are looking for sells, right? We are looking for sells. So the main thing we focus on, the reason we say it's buy stops liquidity or it's buy side liquidity is because the dealer wants to take out these buys or these buyers who are still going long, and we want to sell. All right, so each time we are selling, we are taking out the buys. That's where the term buy stop liquidity or buy side liquidity comes from. So we have to look at the previous month's high, previous week high, previous day high, HOD, or the old highs or equal highs. That's where our point of interest will be. So all these levels are what we refer to as our points of interest. All right. So illustration, like the author said, if you are looking for sales, the buy side has to be taken out, or prices to come trigger buys. Then take out anyone who still or maybe someone who sold here has to be taken out. Then price will drop. If anybody has bought here, this push down now will take them out. So it's a buy stop liquidity on the top side, or buy side liquidity. All right. So the scenarios you're going to get the market structure is going to look more or less like this. So if your price was coming up, as you see on the illustration above, there has to be a certain high formed, and it's always a good thing if this high is formed on another point of interest, which can be maybe an order block from another time frame or from that current time frame. Then what happens is price will come slightly above, take out anyone who's on this trade, or take out liquidity rather, so that I don't confuse anybody. Then the price is going to sell. So you can have a scenario like this, which is the first one, or sometimes price will hit you with equal highs, which is your normal resistance. So usually we will sell here, sell here. This price will come take you out, but still move in your way. So the best thing you want to do as a trader before you take your trade is you want to identify the liquidity sweeps first, right? So this is also your liquidity sweep. You might hear me refer to this as a liquidity sweep. It's just a phrase referring to this price movement coming up and sweeping these highs, then coming back down. Price coming up, sweeping these highs, then coming down. So that's your liquidity sweep as well. So it's just like different phrases which mean the same thing. So this market structure has to happen on the previous month's high, previous week's high, previous day's high, on the high of the day, or on any old high, which you can visibly see on your charts, right? So here we are going to start with an example of the month. So we're going to look at the previous month's high. So if you're looking at your charts, how do you identify the previous month's high? So you can do it in two ways. The first way, I'm going to explain how the author shows it. The second way, I'm going to explain how I view it. But you can use both, or you can use one of the two, whichever makes sense for you. So if you come on your monthly chart, right, you are on the monthly chart, or the M1 or the 1M. If you're on your monthly chart, you just want to identify the last monthly candle and mark the low, mark the high. So of course, if you want to sell, you are paying attention to the high because you want price to sweep above the last high, then retrace or reverse back into the range of this particular candle. So on a smaller time frame, the setup will look more or less like this. So this is on the monthly time frame. But you should know that you can also view this from your daily time frame. I think it will make more sense when I open the charts so that I don't confuse you guys. So I'll just explain that when I open the charts, that second option which I mentioned. So from the author's perspective, you can open your monthly charts. Just pay attention to the previous month's high and the previous month's low. You can put a line, then see how price reacts. If you get a liquidity sweep like this, then you can start looking for your sells. All right, so the next in line is the previous week's high. The author uses the weekly chart to view the previous week's high, and I personally use the 4-hour chart. So I'm going to explain how I use this chart, like I said, when we get on the actual charts. So if you're on the weekly chart, Again, you simply want to mark the previous week's high and the previous week's low. So on the high, if you're selling, once you get a sweep like this, usually a sweep is just like a wick above that last high candle or that last high you see. It's usually characterized by a wick like this. Then the candle will form uh usually below that level, which would have been swept with that buy side liquidity. So if you're on the weekly chart, just mark the last week's high, last week's low. You see there's a liquidity sweep. So we start looking for sell motion. Another example here, whereby the price weeks above the previous week's high, then starts to expand going to the downside. So those are the main things you simply have to look for. And here's another example, another sweep, then price expanded to the downside. Then the next illustration is when price takes out liquidity on the previous day's high. So when you open your charts, you simply want to mark the previous day's high and low. So the author here uses the daily charts, of which personally here I use the H1 or the M15. Any time frame H1 and less, you can also use it to mark your previous day's high. So you simply look at your charts on your current day of trading, you look at the previous day, mark the high, mark the low. So if you're on your daily chart, simple, the high of the previous day, the current day which you're on, once you see this wick forming or this candle forming, you know price is about to reverse and liquidity has been swept. Again, here we've got a liquidity sweep which actually takes out the previous 2 days highs this week here. Then price expands to the downside. Another week, another liquidity sweep, price expands to the downside. So if you see from these illustrations, each time price takes out the previous day's high, the candle which takes out that liquidity is closing below the previous day's high or previous week's high or previous month's high. That's something which you just need to take note of. And this is now when you're on the current day, you might hear others refer to this as an M pattern. You might hear others refer to this as a multi-session M, because usually on the same day, here the author is using the M15, which is also the time frame which I use if I want to check the high of the day. And if I want to map out my liquidity, we use the same time frame here. So usually there will be an M pattern, and sometimes this first leg, we usually refer to this as a leg. It happens during your London session, and the second leg happens during the New York session. So you might hear someone refer to this as a multi-session M. I also refer to it as a multi-session M. But again, you just need to know what you're looking for. If you've got a bias of where your price is going, it now becomes easier because you know that on this day you are looking for sales. So if price creates any high on that particular day, on the next session, price will usually come due the buy side liquidity, and then they will now sell. So anyone who sold here, sold here, sold here will most likely have their stop loss here, then they will be taken out. Others will take this as a buy stop. Then once the buys are active, price will retrace, then they are taken out. So that's your buy stop liquidity taken or your buy side liquidity taken. And if you're on the HOD or high of the day, that's your current day. It usually happens, these legs usually happen in different trading sessions. That's also one thing you should take note of. Then sometimes you see on your charts, you identify equal highs at some point. So if you identify equal highs, you mark that area as a point of interest. Most of the times, price will still come take out liquidity just above those equal highs, of which this will still be a valid resistance. So again, once you mark that area, remember it's a point of interest. So you want to wait first for the liquidity sweep to happen before you take your sell. You don't want to sell here and put your stop loss above here, because usually the dealer will always come take out something or frustrate someone before price goes the other way. So this is an example whereby you'll be having equal highs. So these are all examples of buy side liquidity. Then sell side. Okay, before we get into the sell side, let's quickly jump into the charts so that people don't get confused. So like I said, the dealer used the monthly charts to identify or to show us the previous month's high. So a quick example, if you are in a sell motion or if your price is trending down, I always say this. Usually the textbooks will tell you that a downtrend is like this. And the actual price action, price will move like this. All right. So what will simply be happening is in a downtrend, you are looking for buy side liquidity. That means each time price does a swing high, you want to mark that level. Most of the times people get confused when this price is coming back up. Once we break this level, they'll be looking at this textbook example. So once a level is broken, people start buying and think it's reversing. Rather wait and see if price is actually going to break the last swing high and retests for buys, because most of the time what happens is price will just do a liquidity sweep, then they will continue pushing down. They will do another liquidity sweep, then continue pushing down. So each time you identify that you are in a selling trend, look at your swing highs to identify your liquidity areas. That's where price will most likely retrace to do a liquidity sweep, then continue with the sells. So how do we view it from the H1? Just like the author said, the main thing you're trying to do is you're looking at the previous month's high. So we're just going to start from the left-hand side of the screen, coming all the way down, because here we can clearly see it's a downtrend. Of course, here it's now back testing, so it looks like it's a little bit clearer, but I'll show you how you can identify it once you get to your current month. Right. So from our left, this was the high of the month, 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 liquidity sweep. Once you identify a liquidity sweep, now you know that you are for sure selling. Then you can start to look for, or you can start to identify any sell patterns which will be available for you to take on a smaller time frame. So if you are able to see it from a monthly time frame, it's also good because you know that long-term price is most likely going to continue in a bearish move. So if you're on a smaller time frame, like let's say H1, right? This is for day traders. If you're on H1, if price was selling and you see them pushing up, just know that that push up you're seeing is a retracement and price will most likely continue pushing down based on that liquidity sweep on a higher time frame. All right, so let's continue. High of the month, high of the month, high of the month, high of the month, liquidity sweep. High of the month, high of the month, low of the month, low of the month. Now here price delivery changes. So soon as the high is now broken and the candle closes above, it means that sell trend you were seeing is now over for that time. All right, so you now start to look for the buy side liquidity, which sorry, for the sell side liquidity, so that you can start looking for buys. So let's see where can we identify another buy side liquidity. Right here you can see we got this nice wick above 3 months highs, so that's also a valid liquidity sweep and we can start looking for sells. So basically on the monthly, that's how you look for it. But personally for me now, I like to use the daily chart. So how I use the daily chart is this. On my daily chart now, I'm able to see the full 30 or 31 days of trading, right? The full month. The fact that I've got these period separators, if I come to my daily chart, I know that this is representing the month of April. This is our current month, which is May, April, this was March. So I'm able to see the full expansion of price. So let's just take a look at these months which we are looking at right now. So once I come to my daily, the previous month's high will just be the highest price point during this month period. So from here to here, what's my highest price? It's right here. I just mark that area. Then the next month, sorry, the low will be right here. The month of April, this was the highest point and this was the lowest point. So those are my points of interest. That's how I prefer to market so that I can view the full expansion of price. Because on a monthly candle, the candle will just look like this. Okay, so let me go to where there is sell side liquidity so that we don't get confused. All right, all right, all right, all right. Let's see right here, for example. So here you see that this was the month of May 2024. This was our high. If you put your high into the future, you see that the perfect sell actually happened here when we had a bigger liquidity sweep, a buy side liquidity sweep, then price started expanding down. So as a day trader now, once I see this liquidity sweep, I know that for the next 2 to 3 days, price will most likely be pushing down. Then we might get a retracement. Then we might get another 2 to 3 days of a push down retracement, just like that. That's why I prefer to mark these levels on a daily time frame. And you always want to identify a liquidity sweep which is like visible to your naked eye. These ones here, yes, it's a liquidity sweep, but if you notice here, we had a close above the previous month's high, and here we had a close below, and they kept playing around that area until they did a bigger buy side liquidity sweep. So you always want to wait for one which is a bit more visible. Yes, you might start looking for sells here, but they can be low probability. Just try to wait for the liquidity sweeps which have like bigger wicks. Those are the best ones. So if you come back to the daily, we are going to check the month of May and June 2024. So we go to the monthly. We want to check the month of May and June. You can see right here. I think this is it if I didn't get it wrong. This was May and this was June. So if you are looking at it like this, sometimes on the monthly, you might feel like maybe price might not move, right? You see this sweep here, you might think that price might not move. But what you realize is if you're on a daily, you actually see that there was actually some good expansion during that time. Okay, let's just come back. So for a day trader, there was actually some good price expansion coming to the downside. We could actually have had a nice selling day here, a nice selling day here, retracement, nice selling day here, nice selling day here. So that's 4 or maybe 5 good days where we could have sold. But on the 1 hour, on the monthly candle, the candle is so tiny, you might think there's nothing. So that's again one of the reasons I love to mark the previous monthly high on the daily. It makes it a little bit easier for me. Then if I want to mark out the previous, excuse me, the previous week's high, I'm going to use the 4-hour chart for the same reason, because I want to see fully how my price was actually expanding during the whole week. So you see also I've got period separators, which means that this is a fresh week. Today is Monday. So this is our current week. This was last week. This was the week before last. So without going too far, the week before last, we can all agree that this was the high, right? And this was the low. So from this high, you see price actually came, then we came back below and we started trading below. We never came back up to throw like a big wick above the previous week's high. So these are what we call variations. Sometimes a liquidity sweep is going to be a nice big wick above that previous week's high. Sometimes the pattern will just look like this. So what I want you to focus on, if a pattern is looking like this, if you've got a solid line here, pay attention to how price will react, because usually if price comes below that zone, so let's just mark this high. if we do this liquidity sweep and come below, usually you see price retesting that high now from the bottom side, just to show you that that liquidity sweep was actually valid. So on this one, I think the author uses the weekly chart. So if you're on the weekly charts, let's zoom in. You see that this was the previous week's high. You can see there was the liquidity sweep. So instead of waiting for your weekly candle to close, this move you could still have traded it last week, because now you can see from that liquidity sweep the price actually started to show a downtrend for that particular week. So once you identify a downtrend, now it's easier for you to look for trades, because you're waiting for price to retrace, look for your sell, retrace, you look for your sell, they retrace, you look for your sell, until the trend actually changes. All right, so the next one is the previous day's high. I think the author used, what time frame did the author use? Let's quickly go back to the book. Check. I think this session is going to be long, so you guys just have to forgive me. Okay, here the author looks at the daily chart to check the previous day's high. I use the 1 hour for the same reason. I want to see the full expansion of my price within that 24-hour period. So the author is using the daily. There's literally nothing wrong with it. You simply need to understand uh, the price movement, and you can use whatever works for you. Like I said, you can use both ways to identify the previous day's high. So again, if you're in a sell motion, so here we don't have any visible liquidity sweeps from the previous day's high. Let's identify where we've got a bearish move. So I'm just going to highlight this area here. So here price is bearish from the previous month, which we're not going to look at. Here we get a liquidity sweep. So price sweeps above the previous day's high, then we start to sell. Previous day's high, previous day's high, previous day's high, previous day's high. Then the trend actually changes, retraces a bit. 2 days, the highs of these 2 days was taken out here. Price continued to come, but there was an SMS. Do you guys remember SMS from the previous structure, which is a failed swing low? This means your trend has changed. Once your trend has changed, we are now looking for buys. So don't forget also to apply whatever we've learned on all these setups, which I'm explaining. So like I said, for me, I prefer to use the H1 now to look for my previous day's high. So what I simply do is, on my other charts, there's actually an indicator which just paints a faint line. Every previous day's high is demarcated by a faint line. So let's see if we can be able to identify any visible liquidity sweeps here. This is almost one right here. Let's actually put a line. Let's see. So you simply focus on the previous day's high. Then once your price spikes above that high, you know a liquidity sweep has formed, and the trend will most likely go in the opposite direction of that buy side liquidity sweep. So I think this video might be long. You guys might have to like research or backtest rather on the sell side liquidity, but we'll go through it on the book. Then your assignments will just be to open your charts and do the backtesting, because I feel like this session might end up being a little bit too long. But anyways, if I'm looking for my buy side liquidity on the H1, I always like to look at my previous day's high. Sometimes price will not take out that high, as you see here. This is what I call a variation. So let me actually highlight that. So as much as you want to focus on this high like this, sometimes price will actually respect the high of the candlestick bodies. So sometimes it's good to mark it as a zone. So that whole week to the candlestick body, you mark it out like this, right? So what do you notice when price came up here? We were waiting for them to do a liquidity sweep so that we can sell, but they ended up doing the HOD liquidity sweep. So the current high of this day was here. Then during New York session, they did a liquidity sweep and tapped into this high right here. So that's now a variation, and this is your HOD liquidity sweep. So I'm just combining them into one now. The HOD liquidity sweep, you can identify it from the H1 time frame going low. So H1, M30, M15. That will just be the high of the day, which is taken out in another session. Usually, most of the times, it will be taken out in another session. If you look at this price action here, initial high at London session, then at New York session, we had a liquidity sweep, then price sold. Most of the time, if you're selling from the top side, price will usually come towards the bottom side or the low of the day. So whichever move created the liquidity sweep, price will most of the times come to the bottom side. Here's another example whereby we had New York setting this high, then the Asian session gave us the liquidity sweep. So as your assignments, you can just backtest on whatever you trade. Check which time frames work for you in terms of looking for this liquidity, but both ways work just the same. The only thing you need to do as a trader is to understand price action. All right, so without wasting much time, we're going to go to the sell side liquidity or the sell stops liquidity. This is when we are now looking for buys. So I'm just going to read a bit fast because I feel like this video is now slightly long. So I'll just try to be fast also so that I can see if I can go to the charts and show you an example. So sell stops liquidity, the SSL is originated by stop losses of buy orders. After the SSL is taken, the market reverses to the upside because banks use SSL to place buy orders in the market. What do we focus on if we're looking for the sell side liquidity? We pay attention to the previous month's low, previous week's low, previous daily low, the low of the day, and any old swing lows and equal lows, which is usually your retail support zone. So each time you're buying, these will be your points of interest. So if you can identify a trend, it now becomes easier for you to actually look for this. So as long as you identify that you are now buying, just know that the best setups will now form when price does any liquidity sweep here, and that trend will actually continue pushing up. All right, so this is what we're looking for. This is the market structure you are looking for. So you're looking for areas where you can get equal lows. Then when price is coming for the third time, don't put a buy stop here, because what usually happens is if you put your buy stop here, your stop loss is going to be here, and price will take you out with that sell side liquidity. Then they will still push in your direction. So what you want to wait for, if you identify equal lows, you can still just wait for that liquidity sweep. Then after you visibly identified it, then you can execute your buy. So these market structures, where do we get them? We look for them on the previous month's low, previous week's low, previous day's low, the LOD and the old lows. That's where we look for these patterns. So, all right, so let's say this was the previous week. Price will simply come back to those lows. If this is the 4-hour time frame, H4, we have our period separators. Monday, Tuesday, price comes, takes out the lows from the previous week, pushes up. Same applies here. If this was H4, and if this, okay, just a moment. All right, if this was your H4 right here, and this is the new week, price comes, takes out the lows from the previous week with a nice sell side liquidity sweep, and they start pushing back up. If this is your HO, not HO, LOD, because we are selling, so we are looking at the low of the day. Let's do this. If this is the LOD on the same day, let me remove all this. If this is the LOD, meaning this has happened during London session, and this is New York session, we are looking forward for this liquidity sweep, then we can comfortably take our buys. So most of the things will start to make sense as you are doing your analysis, like your multi-time frame analysis or your top-down analysis, because now you will have more confluences to use in terms of having a bias. So once you get a bias and a trend, it becomes easier to look for these sell side liquidity sweeps. All right. So again, the author is looking for the previous month's low. The author is using the monthly time frame just for quick highlighting. So if you are pushing up each time the low is swept, that's your sell side liquidity taken, and you start looking for buys. What I'll say is if you're a day trader and you identify this on a higher time frame, it's just giving you the long-term bias. So you start looking for buys, buys, buys in the next following days and weeks. But just for a quick illustration, I think that's why the author used these higher time frames, because it's faster to illustrate or to show these points. All right, so the previous month's low is here, clean liquidity sweep here. Previous month's low is here, clean liquidity sweep here. Previous month's low, clean liquidity sweep. Previous month's low, clean liquidity sweep. Here we had almost equal lows, but there was no liquidity sweep until the trend changes. Another example here, previous month's low, liquidity sweep. Previous month's low, other months or other times there is no liquidity sweeps. That means you need to look for other confluences, or you can look for the liquidity sweeps on smaller time frames as long as you've identified a bias, right? Previous day's low, the author is using the daily time frame. Same thing. I think we won't waste time here. You just want to identify the low of the previous day. Once you identify it, if the next day sweeps below that low and comes back above, you know that you are looking for buys, and that will be a valid sell side liquidity. So previous day's low, previous day's low, previous day's low, all the way up until here where we get a minor liquidity sweep, but there was no follow through. Rather, there was a bit of an SMS right there, and price sort of retraced. Then from here, we got another liquidity sweep, and price continued pushing up. So most of those things you guys can just back test. M15, the low of the day. This is the example I mentioned. On your current day, I'm happy the author highlighted that this is actually the same day. So this is from your midnight until the day ends. Asian session, London session, New York session, the day ends. So if London sets a low and we have a buy bias, just have it in your mind that chances are price will do a liquidity sweep during the New York session, and that buy will now continue. So anyone who buys here, 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 and puts their stop loss here, here, or here, that stop loss is taken out. So now, because you have this information, that gives you that confidence to patiently wait for a liquidity sweep first before you actually execute a trade. Here's another low, liquidity sweep taken, price pushes up. So I'm not going to go deeper into these things because I'm now rushing to get into the actual charts. So when the buy side liquidity is taken, the market reverses to the downside. When the sell side liquidity is taken, the market reverses to the upside. Those are notes which you need to put to actually write down. So one other thing, if you are confused about liquidity, you can also just treat it as a stop hunt, right? Or manipulation. Remember, these terms, they usually just refer to the same thing. So don't get confused. You hear people talk of manipulation in a certain way. You hear people talk of liquidity in a certain way. You hear people speak of stop hunts in a certain way. But just know that everything is boiling down to just one thing: liquidity. So stop hunt is a movement used to neutralize liquidity or stop losses. It's a false breakout above or below the zone where there is liquidity. So you can see everything here, it works hand in hand. It's simply the same thing. So the market makers or the banks usually use high impact news to take liquidity. Those who follow me or those who are in my community, or if you've watched my videos, you hear me say I usually don't trade fundamental news because most of the times those high impact news will come and induce liquidity. So let's say price was coming up for the day like this, and we are going maybe into NFP, right? We have a high for the day here. NFP might come and spike that price up, then come back below. So instead of me trying to guess or buy NFP because I just want to catch a fast move, I would rather wait and identify a liquidity sweep so that I can catch the bigger move, which is going to be happening after that liquidity sweep. So this applies to all high impact news. Sometimes, sometimes it doesn't happen always. Sometimes high impact news will usually take out that liquidity. So that's also one thing you just need to take note of. So this is GU on the 1 hour time frame. I love how the author is marking his highs. You see, once you mark a level, you want to mark it into the future so that you can use it once you identify a liquidity sweep on that area. We have a swing here, which is also an SMS. If the trend was coming up and fails to take this high, this is now an SMS or a failed swing from the previous chapters. We break a structure, we drop. You can run your fib here. Once you identify this high here, sometimes you might sell here. So let me tell you something. If you take a sell here, let's say maybe you had run a fib and you've got a 61.8 level here, and you're seeing this as a resistance and this as a resistance as well. It's pretty much simple. If your stop loss gets taken out here, but you are able to identify that this was actually a liquidity sweep and you were correct in selling, then you can still take a sell here, recover your loss here, and still close the day with a win. That's also one way to approach these zones, because sometimes it's hard to understand the direction of the day. Because, for example, let's say we were in a bearish motion from here and we thought this might actually do this, which means we did not buy here. Maybe, for example, for some reason, we did not buy and we were looking for sells, right? What you want to do is make sure every point where your chart turns, you just want to mark that level. So multi-time frame analysis is going to help you in figuring out the trend or the direction for the day. And once you pick the direction or the trend, you know which side has to be trapped or which side has to be taken out in terms of liquidity sweep. If you identify that you are in a buy motion, then you are looking for sell side liquidity to be taken so that you can buy. If you are in a sell motion or in a downtrend, then you're looking for buy side liquidity to be taken out so that you can sell. All right, so what else? So this is just the same illustration, different pair, different time frames as well. So you can look for these things on different time frames as long as you understand what's going on the bigger picture. It will make more sense for you. So here we get a low, price comes to the same low and they give this wick, already you will know that, okay, that's a sell side liquidity taken or sell stop liquidity taken. So now you can start actively looking for buys. Again, here we actually had a liquidity sweep here, but it all depends again with whether there was a point of interest here. So once I see this, for me, I can actually take a sell here and target this last low as my take profit. Right. Then from that high, which left the liquidity, price actually came to that same area, took it out, took out the buy side liquidity, then they sold. So sometimes you can aim for this level. Price might not get there sometimes. That's where your risk to reward comes in. So you can just aim for your normal 1:3, 1:2 risk to reward ratio. Then as soon as your trade hits the 1:3, if you leave any positions running, then you can see if they can run all the way to the next side. Right, high impact news events. This is what I just mentioned. The high impact news events are used to hunt liquidity in the market. Always pay attention to the news calendar to know the pairs that will move. Generally, pairs with many news focused, high impact, those pairs are going to move trending during the week. So like I said, you want to identify a trend. Trading will become more easier for you, or it will become more understandable for you as long as you can identify a trend or a direction, either for the week, for the day, or for the session. As long as you're able to identify a trend, it will be easy to look for setups. So our next chapter is going to be order blocks. That's the next chapter we're going to look at. So before we get into this one, I just want to quickly show you that even if you're trading synthetic indices on Deriv, this is volatility 25-1S, whereby we identified that, okay, we had the highest high here, um, a liquidity sweep, break of structures, price started to sell, failed swing high, SMS, we failed to take out this high. So we know for sure we are in a sell motion. If you are in a sell motion or in a downtrend, pay attention to these highs which are left, because usually price will come take out liquidity and then continue with the selling, like what you see here. So we identified that we are in a sell motion. As soon as we started to break some structures, and as soon as we had an SMS here, we started breaking order blocks, which we are going to speak on the next session. Price dropped. When we got here, we had these highs. We had a liquidity sweep. We got here, we had this high. These are HOD liquidity sweep, buy side liquidity sweeps. So we know we are selling. There's no way we're going to buy if our trend is showing us that we're selling. So each time we see price break any previous high and we get that liquidity sweep, then we sell. Each time we see price create a high and break that high but come back below, we know it's a valid liquidity sweep, then we sell. Each time we break a high, we know it's a valid liquidity sweep, then we sell. You're not trying to hold the whole sell move. You are trying to catch a piece of the pie. You're trying to catch a piece of the pie. So as long as you're able to identify these things, it becomes a little bit more easier and more fun to actually take your trades. So here, let's see if I can be able to quickly show you any. Okay, there we go. Before we go anyway, this was GBP USD on Friday. We were in a downtrend, as you can see. Price came pre-London. We had these highs. New York session comes, takes out liquidity. Price sells all the way to this low. Right here, we've got this low. Price fails to take it out. Looks like this could be a potential SMS, but we still need this level to be broken for us to start buying. Then, soon as we confirm a buying trend, we'll start looking for sell side liquidity so that we can start buying. As long as you understand what's going on, guys, it will become way more easier to trade. It will become more interesting. So whatever time frame you trade, if you are able to identify a buy trend, let's say on the 3-minute time frame, your higher time frame you've already analyzed and you're in a buy motion, and 3-minute gives you a market structure like this, and they take out liquidity here, that means you can still buy this here, stop loss here, target this as you take profit, just like that. So whenever you are able to identify a trend, it becomes slightly more easier to actually trade. This is the low of the week. Check how they just came and swiped that sell side liquidity right there. And we simply came back above, and this trend continued for the whole week. So if you're able to identify your trend, it will be very easy to actually trade. Here's another example. I'm just picking random examples now. We had a high here, liquidity sweep, then price sold. Anything else? So what you can do on your charts now is you simply need to identify the high of your week, previous high. It can happen within the same week like this. You get a liquidity sweep, then price sells back into the range, or price can take liquidity above the previous day's high like this, then quickly come down. So this one is more or less like invalid, but yeah. The main thing you just want to focus on is your weeks. When there's a liquidity sweep, usually there will be a wick above, then price will come back and close below. Those are the most valid liquidity sweeps. And if you can identify a liquidity sweep, it's easier for you to actually come up with a trade. Again, here we had these lows initially for this week. Then we had price doing a liquidity sweep, coming back, retesting. Then the sales started forming. So that's it from today's chapter. I hope you guys took something from this session. I'm sorry, you guys, this session was a bit long. I think it was also a big chapter. But just know the longer the session, the more information being relayed on that particular chapter. So when we come back, we're going to jump into chapter 4, which is going to be order blocks. So thank you so much. If you watched until the end, let me know if you managed to catch any points on what the author was saying and how I was explaining it. Let me know if you're still struggling so that I can do maybe like a part 2 of the same chapter so that these examples can be a little bit more clear. So special shout out to WadeFX, who is the author of this book. For those who want to follow this author, WadeFX, you can follow him on Twitter. This is his handle, WadeFX Setups. If you want to follow him on IG, you can just put at Wade_FX_setups. Then for those who want to join his Telegram channel, you can just follow this link. I'll drop this same link in my description so that you can follow him as well on his actual groups. So special shout out, much appreciation to Wade for giving us the opportunity to go through this book, which is Market Structure and Powerful Setups. If you watched until the end, thank you so much. If you haven't yet subscribed, please do hit the subscribe button. Don't forget to comment and share with your friends as well. Let us know if you took something from this book. Let us know if the previous chapters are making sense and they are helping you out in your trading journey. Enjoy the rest of your day. Good trading.